Hello friends, last week I advocated that the bulls would have to climb over a wall of worry, and to be able to get back in the driver's seat they would have to surpass a very strong US dollar, rising crude oil prices and some amount of nervousness in the market. Well, ever since the Nifty crossed above the 19,585 levels, which I advocated last week and also wrote about in my live mint column, bulls were back firmly in action, and it looks like the Mount 20,000 on the Nifty will be in all probability overcome in the coming week. The feel-good factor about the G20, where India would sign a lot of trade deals, especially the FTA with England, seems to be the optimism here. Now, do remember that I had recorded a video some weeks ago wherein I had advocated that rising oil and gas prices would not drag equity markets because this was a known. It's a factor that the savvy traders already know, and therefore it's not a surprise. You can access that video in the description and in the pinned comment below. And right now, let's dive right into the market roundup window, which tells us that the rally was broad-based because the Nifty has outperformed the Bank Nifty in relative terms. The US dollar index has crossed the 105 levels, but that did not dampen the enthusiasm of the Indian equity markets, which outperformed most of its global peers. A strong dollar exerted downward pressure on commodities, and bullion typically saw profit taking. Crude oil went up because I have been telling you it's hurricane season in the US, and the announcement by the Saudis about extending the output cuts till end of this calendar year also lifted prices. Natural gas fell because the impact of the Australian strikes at Chevron were deemed to be muted, and storage capacity in Europe is nearing full. The USD INR, which is the United States dollar versus the Indian rupee, gained 39 basis points and climbed the round number of 83, which means the rupee has slipped a little against the dollar. Had it not been for this, the rally would have been even more stronger. The Indian 10-year benchmark bond yield rose 1 basis point. That means bond prices fell very marginally. The NSE market capitalization gained 2.74%, which means the rally was fairly broad-based. MWPL, or market-wide position limits, rose, which is routine after the expiry. US indices were down uniformly, and that provided headwinds for domestic markets. Friends, I now come to our in-house indicators, starting with the market-wide position limits. This tells you how much the exposure the traders have utilized as a component allowed by SEBI. Do note that this is the fifth consecutive week where post-expiry low has been higher than the previous week, and in the week after expiry we are at 34.95%. That has not occurred in the last 5 months. So risk appetite remains fairly high, and do remember what I told you last week in this segment itself. Now that positions are built up to a fair degree, to a high degree, volatility will go up, for the simple reason that one of the two parties will surrender their positions, and since these positions are large, very big price moves can occur. So get ready for extended price mobility. Now for the stock and index futures turnover chart. Every 4 weeks you see a spike in the turnover. That's because of rollover, when traders close their trades in the expiring month and initiate them in the next month, which means double turnover. So the decline in the indices and stock futures turnover is routine post expiry, but the fact remains that it's at the nearing the lower end of this 20-week period. So the traders have taken a fairly cautious approach. Now I come to the advanced decline ratio, and this is an average of all 5 trading sessions of the week. It's a 20-week look back period, and the Nifty may have gained 1.98%, which is represented by a red line, but the advanced decline ratio has eased somewhat from 1.37 in the prior week to 1.28 last week. I had told you that these lofty levels of 1.37 in my last video would see a little bit of cooling off, and there you have it. The bulls still remain in control, but their buying enthusiasm was a little tapered. As long as this ratio is above 1, bulls still have a chance. So net, the outlook is still positive. Now for the Nifty and Bank Nifty prompt futures basis. Basis is nothing but premium or discount prevalent in the futures compared to spot. Basis also comes down like options premium as the derivative cycle proceeds and approaches expiry. So what you are seeing is the Bank Nifty basis shown as a red line eased mildly, whereas the Nifty basis came down, relatively speaking, more in percentage terms. But as long as the basis remains positive, which means the futures are trading at a premium to spot, all is well in the bull camp. Friends, I now come to our in-house exclusive indicator you won't find anywhere. You've trusted it for almost 7 quarters now. This is the impetus, and what you are seeing is that the impetus or the velocity and force in both the indices has gone up. And do note that both the indices have risen in price terms. So last week's rally in both the indices was accompanied by greater momentum, greater force, which is a good sign. And I update these charts on my social media accounts every day. So do connect with me, especially on my free Telegram channel where I put up most amount of data there. Friends, I now come to another in-house exclusive indicator that we have programmed, the Lift Weight Thrust Drag Index or the LWTD Index. You're seeing that the Nifty has shot up into a positive zone after staying in the negative territory for 6 consecutive weeks. And the LWTD, which was in negative zone last week, has now turned positive to 0.10, which means at higher levels, in relative comparative terms, you are likely to see improved buying support coming in, which means that declines will get bought into and therefore falls might just get cushioned. This is another indicator of optimism. Friends, our in-house indicators done, I now come to the bond market, bond yields. And I have been telling you that the bond market is the fountain of money supply for all the other asset classes, and what you have seen is a 1 basis point increase in Indian bond yields. Now, we are still neither here nor there. We are still not below the 7% round number, nor are we above the 7.50, 7.60 levels. So it's still wait and watch as far as I'm concerned. And we are neither laddering these sovereign yields, nor are we getting into gilt funds as yet. But if at all bond yields go above 7.50%, you might see pressure on the Bank Nifty. So let's be watchful out there. Friends, the bond market's done. I now come to the Bank Nifty, which rallied last week, but relatively speaking less than the Nifty 50. And what you are seeing on the daily chart is it's gained 1.62% and rallied on 3 out of 5 trading sessions last week. Thursday and Friday were prominent gaining days, and these were relatively speaking larger candles compared to the prior ones. And the head and shoulder that I have marked on the daily chart has now been kind of negated because the price has gone above the right shoulder. The price is also above a month-long moving average. The moving average itself is turning upwards, which means short-term buyers are now getting back in the money. And for those of my online family who follow harmonic patterns, you are seeing the possibility of a seahorse pattern evolving on this daily chart. Now, if this seahorse pattern was to play out along expected lines, and that would mean staying above the 45,000 round number on a closing basis on all trading sessions, the possibility of 46,500 cannot be ruled out, which means you are looking at a possibility of the Bank Nifty taking a stab at an all-time high. Turning to the weekly chart now, this is the third consecutive week of gain, and what we are seeing is the possibility of an all-time high being reached in the coming few trading weeks. I told you in the previous MWPL slide that the positions built up are substantial, and that means whenever these positions get cut, large price moves might occur. So if short covering comes, the Bank Nifty will see large price up moves. In the week before last, this index was number 6 on the most volatile counters list as per statistical beta list that we maintain in-house. It remained constant at number 6. Last week, I advocated a range between 45,525 on the upside and 43,325 on the downside, which held perfectly well. In the coming week, we are likely to see a range between 46,250 on the upside and 44,050 on the downside. Do remember, large price moves might occur, so trade accordingly. Friends, the Bank Nifty done. I now move to the Nifty 50, which rose on all 5 out of 5 trading sessions, as you can see on the daily chart on your screen. And the price is also above its month-long moving average, and therefore short-term outlook has turned bullish, and recent buyers are now sitting in the money and therefore don't feel any compulsion to sell in a hurry. This is why I said bulls might be gunning for the 20,000 mark this time around, and you could see an all-time high coming. Let's now go to the weekly chart, where you are seeing that the price is comfortably above its 25-week moving average, which is a proxy for a 6-month-long holding on cost. That means medium-term outlook also remains positive. Last week's candle was fairly big. It's a bullish candle, and that is called a power candle, and should follow up buying come in. I think bulls are now likely to get aggressive. Do remember, short covering will also lift prices. Friends, in the week before last, this index was number 13 on our in-house list based on statistical beta of the most volatile counters. It moved up 4 notches and it is now at number 9. So challenge levels for Nifty traders does seem to have gone up. Last week I advocated a range between 19,800 on the upside and 19,050 on the downside. Admittedly, I missed out the high by 67 points because the high was 19,867 as compared to 19,800 that I projected. This is due to the higher volatility, and the coming week's range also will appear smaller because of the low base effect. You could see the ranges that I advocate being taken out in either direction. In the coming week, I estimate a range between 20,200 on the upside and 19,475 on the downside. I would also request you to refer to our free Telegram channel, wherein I put weekly and daily pivot levels for all the indices, that is Nifty, Bank Nifty and Fin Nifty, for our trading family who take intraday or swing positions. So please do join our free Telegram channel and check us out over there. Friends, I now come to the last bit of technical statistical analysis, wherein I gauge the risk appetite of the retail segment by the amount of turnover that they contribute in high and low risk areas. What you are seeing on the chart is index futures, which I have denoted as a blue line. Their contribution fell, and so did stock futures, which are denoted as a red line. Do remember that contribution was higher last week due to the expiry, and this is a routine post-expiry fall in turnover. But do make a note of that. And the fall is substantial. It's almost to the lowest point of the 20-week range. Now, whereas the turnover fallen and risen in the option segment, which is relatively speaking lower risk and it requires less amount of capital, the index options turnover, which I have shown as an army green line, has shot up to the high point, nearing the high point of a 20-week period covered by this chart. And stock options turnover, which I've shown as a purple line, is now fallen to the lower end of the 20-week range. What does it tell you? As a behavioral technical analyst, it tells me that wherever capital requirement is high, that means futures, and also risk and volatility is high, that is again futures, turnover has fallen to near the 20-week lows. And wherever there is, relatively speaking, less volatility and less capital outlay, which is index options, contribution is nearing a high. So yes, risk appetite is there in the retail traders, but they are playing a very safe hand. They are playing in index options rather than index futures. So let's watch what happens in the coming week. We will need more follow-up buying to go past the 20,000 mark, and it shouldn't be just a kiss and fall. It should be a kiss and continue kind of a rally. Friends, I now come to my own trading game plan for the week ahead. At least since the last 6 weeks, I have been telling you that I will continue to stick to a formula of trading public sector units. As a matter of fact, I have recorded a video in April 2022. Although this video is 17 months old, the validity of the arguments and the statistical plus points that I have told you about why you should trade PSUs are evergreen. Do check out this video in the description below and in the pinned comment below this video. So why change a formula that's making you money? Stick to PSUs. And I also mentioned that metal stocks will see larger than average price action because the price of base metals on commodity exchanges were buzzing. Now a few short-term supports on commodity prices, base metal prices have been broken. So metal stocks might just see some more outflows. Oil marketing companies, OMCs, may see some pressure because oil prices are up and that is impacting the cash flows of oil marketing companies. In the commodity space, oil and gas will remain volatile with buying coming in at dips in the absolute near term. Oil output from Nigeria and Libya has also come down, which is likely to cushion decline. The Saudis have extended output cuts, as I told you, for 3 more months. And in the Australian Chevron LNG plants, the strike by striking labor unions is likely to witness some volatility in natural gas prices. Although I'm saying that in the near term, oil and gas might just go up, I maintain my view that I have been steadfastly maintaining since 2021 that I don't see a super cycle in commodities, whether it is industrial metals or energy. These are bull markets triggered by man-made artificial shortages and supply side constraints, easy money available because of the huge unbacked currency printing after COVID, which is triggering price rises. The long-term view, therefore, hasn't changed. Friends, I now come to the most popular segment of this video for statistically minded traders, wherein I give you 5 stocks that gain the most amount of statistical impetus on Friday, where you take small exposure, wait for large price moves, and 5 stocks that lost the most amount of statistical momentum on Friday, where you take big exposure, wait for small price moves. These are for scalpers. Do remember that this list is valid only on Monday, Tuesday through Friday. I update this list on our free Telegram channel. These are only momentum gainers and losers. Direction will be decided by the market as to which way the price is moving as per your snapquote window that I have given you in my tutorial of how to read the snapquote window. Now, impetus gainers list is led by Petronet LNG, followed by Coal India, then UBL, Sri Cements and Rural Electrification Corporation. Impetus losers list led by India Bull Housing, MFSL, Reliance Industries, Ambuja Cements and Adani Enterprises. Friends, before I sign off from this video, do subscribe to my YouTube channel if you haven't already done so. Also, click on the bell icon to receive instant alerts about fresh videos being put up out here. Hey, also do let me know how my videos are helping you decipher the signals of the market better by letting me know in the comment segment. And please help me reach out to fellow like-minded smart traders like yourselves by sharing my videos with your family and friends and social media groups. I thank you for your patience and being with me in this video. I wish you have a very, very profitable week ahead till we meet again in my next. This is Vijay Bhambwani signing off for now. Take care. Bye-bye.